Welcome to the deep dive. Today we're taking a really fascinating look back at a moment that truly shaped modern economic history.
We are. We're diving into the Wall Street crash of 1929.
And to guide us, we've got excerpts from a detailed document. It really lays out the events, the causes, the consequences.
That's right. It gives us a solid foundation to work from.
So our mission today, let's get beyond just the famous images, the panic. Let's unpack the key events, understand the factors underneath it all.
And really grasp why this period, this crash, still matters so much.
Okay, let's get started. The document paints a picture of the Roaring Twenties, the decade before the crash.
Yeah, it was a time of, huge optimism in the U.S. after World War I. Loads of industrial expansion.
And a big shift, right? People moving from the countryside.
Exactly. Rural Americans heading to the cities, looking for that prosperity everyone was talking about. A real sense of increasing wealth.
The roaring part suggests a certain extravagance, too.
Oh, definitely. It wasn't just about having more money. It was a cultural shift. Consumerism, easy credit, new entertainment. It all fit into this vibe.
And banks weren't offering much on savings, were they? Low interest rates.
Precisely. So ordinary folks started looking at the stock market. It seemed like a much better place to put their money, even small amounts.
Which led to this widespread belief.
Yeah, almost a conviction, really, that the market could only go up. It just wouldn't stop climbing.
And that belief fueled speculation. People buying stocks for more than they were, maybe, worth.
You got it. Investment became less about the company's actual value and more about just riding that upward wave. Prices got disconnected from reality.
Now, here's something that really jumps out from the document. Margin buying.
Ah, yes. Crucial point.
People borrowing heavily to buy stocks. The figure mentioned is, wow, over $8.5 billion on loan by August 1929.
Uh-huh. And get this, that was more money than the entire amount of U.S. currency circulating at the time.
That's hard to wrap your head around. It just screams instability.
It really does. It shows how much leverage was built into the system. Think about it like a tiny down payment on a huge mortgage. Any dip in value is magnified.
And the document mentions the price-to-earnings ratio, the PE ratio.
For the S&P composite stocks. It hit 32.6 in September 29.
Which is high.
Very high, historically speaking. You'd normally expect something maybe in the teens, low 20s perhaps. So 32.6, that screams inflated prices. A bubble.
And it wasn't just individuals. There were these complex investment products, too.
Yes, things like Goldman Sachs' Blue Ridge Trust and Shenandoah Trust, basically leveraged funds holding stocks, borrowing to amplify returns.
Which also amplifies losses, right?
Exactly. When the market turned, these things just collapsed spectacularly. Huge losses for the banks involved.
So you've got this mix. Optimism, cheap money, speculation, huge borrowing, complex finance.
It's a perfect storm brewing. The whole market was kind of teetering.
But even with this boom, the document points out some warning signs were already there in early 29.
Yeah, subtle tremors, you could say. Agriculture was in trouble.
Overproduction.
Uh-huh. Too much supply, prices fell sharply. Lots of farmers went into debt.
And not just farming, right? Consumer goods.
Same story. Companies couldn't sell everything they were making. Wages weren't keeping up, so people couldn't afford to buy as much.
Leading to production cuts, layoffs.
Naturally. Which, of course, just weakened demand even more. A downward spiral starting.
But the stock market, it just kept going up, despite these flashing red lights.
Pretty much. The Federal Reserve even warned about excessive speculation. There was actually a small crash, wasn't there? March 25th, 1929.
Right. But it didn't stick.
No. A big banker, Charles E. Mitchell, stepped in. He pumped credit into the market, stopped the slide.
So, a temporary fix.
Exactly. It calmed nerves for a bit, but those underlying problems, weak farming, slow sales, debt, they didn't go away. Steel output was down, construction slowed, car sales fell.
Ominous signs.
Definitely.
And yet, the market roared back again, June to September 29.
It did, incredibly. The Dow Jones shot up over 20%, hit its all-time peak on September 3rd, 301.17.
Which was, what, a tenfold increase in 9 years?
Something like that.
Yeah.
Astonishing growth. It felt unstoppable.
Almost like irrational exuberance.
That's the term, isn't it? People were caught up in the fever. Which leads us to that famous quote.
Irving Fisher, the economist.
Yep. He said, stock prices have reached what looks like a permanently high plateau.
Oof. Talk about bad timing. Famous last words.
Heavy irony looking back.
And then just days later, another expert, Roger Babson, predicted a terrific crash.
The Babson break. September 5th.
But people didn't really listen then either, did they? The dip was seen
As a healthy correction, a buying opportunity.
It really shows you the psychology, doesn't it? Even with warnings, people wanted to believe the party would never end.
Fear of missing out is powerful. You rationalize the risks away.
But things got shakier through September and October. The document mentions the arrest of a British investor, Hatry.
Clarence Hatry, yeah. Arrested for fraud on September 20th. It's possible that shook confidence a bit, even across the pond. Made people think about market integrity.
Plausible.
The market was definitely unstable then. Big sell-offs, then weak little recoveries. Very volatile.
And economists started debating the triggers more seriously. Conservatives pointed to the Smoot-Hawley Tariff Act.
Right. There was a big vote coming up on October 23rd. The fear was high tariffs would kill international trade, hurt the U.S. economy.
So investors got nervous about future profits.
That was the argument. Sell stocks before the bad economic news hits.
But then there's another view. Scott Sumner.
Yeah, the libertarian economist. He had a more nuanced take. Said it wasn't just the tariff itself, but the fighting within the Republican Party about it.
Political uncertainty spooking investors.
Exactly. That lack of unity, that political infighting over major economic policy created apprehension. Uncertainty is bad for markets.
And Harold Bierman Jr. brings in other factors from early October.
He does. He points to the British Chancellor, Philip Snowden, making comments about America's speculative orgy.
Ouch. Public criticism.
Yeah. And combine that with moves in the U.S. to regulate public utilities, like FDR setting up that committee in New York on October 8th.
So international criticism plus domestic regulation fears.
Bierman argues those might have been the pinpricks that started deflating the bubble, making investors nervous about certain sectors.
Okay, so multiple potential triggers adding pressure.
Yeah.
And by mid-October.
Selling really picked up steam. Then boom, afternoon of October 23rd, a sharp, unexpected drop.
How much?
4.6% just in the afternoon. That kind of suddy hit. It really rattles people.
Yeah, you can see how that would trigger fear. A feedback loop starting.
Precisely. Which brings us to the day itself, Black Thursday, October 24th.
The market opens and just plunges.
Yeah.
11% down almost immediately.
Nearly 3 million shares traded in the first few minutes. Chaos.
And the ticker tape, it couldn't keep up.
Fell hours behind. Imagine it. You have no idea what the current price of your stock is. You're flying blind into panic.
Pure anxiety. What did the big players do? The bankers.
They had an emergency meeting. Lamont from J.P. Morgan, Mitchell from National City Bank. The big Wall Street names.
And they decided to intervene.
Yeah, they sent Richard Whitney, the vice president of the exchange, onto the floor.
To do what?
To buy stocks. Big blocks of blue chips like U.S. Steel. And crucially, he bid above the current market price.
A public show of confidence, trying to stop the panic.
Exactly. A tactic that had worked before in smaller crises. Make everyone see the smart money thinks prices are too low.
And did it work? Temporarily?
It seemed to. The slide halted. The Dow recovered a bit, closed down only about 2%. A collective sigh of relief, maybe?
It didn't last.
Nope. That weekend, reality sunk in. More investors got margin calls over the weekend. They needed more cash, or the brokers would sell their stocks.
So Monday, Black Monday, October 28th.
The dam broke. Faced with huge losses, people just decided to get out, sell everything. The Dow crashed a record 12.82%.
The bankers' plan hadn't fixed the underlying problem.
Not at all. The leverage was too high, the confidence was shattered.
And then Black Tuesday, October 29th, the big one.
The day everyone remembers.
Yeah.
About 16 million shares traded.
Yeah.
Just unprecedented volume.
And the value lost.
Around $14 billion. Just
Yeah.
gone. Wiped out thousands of investors, big and small.
Utter panic. Stocks with no buyers at any price.
That's what the report said. Just a complete meltdown. The Dow dropped another 11.73%.
So over the 2 days, Monday and Tuesday?
A total drop of 23.05%. Just catastrophic.
Did anyone try to stop it on Tuesday, like Whitney did on Thursday?
Yeah. William C. Durant, founder of GM and some other big names, tried buying huge blocks of stock publicly.
But it didn't work this time.
Too late. The panic was too widespread. Selling overwhelmed everything. The ticker tape ran until almost 8 p.m. that night, hours after the close.
Yeah.
Just couldn't process the volume.
Wow. So what happened right after that? Any immediate bounce?
There was a brief sort of dead cat bounce on October 30th. But it was deceptive.
False dawn.
Exactly. The market started falling again, hitting a temporary bottom in mid-November 1929.
But that wasn't the end of the slide.
Not by a long shot. There was a rally for a few months into 1930, what we call a bear market rally. But then From April 1930.
Another long decline.
Yeah, long and grinding, all the way down to July 8th, 1932. That's when the Dow hit its absolute lowest point in the 20th century.
How much had it lost from the peak in 29?
An incredible 89.2%. Almost 90% of its value wiped out.
Just devastating. And the recovery, how long did that take?
A very, very long time. The Dow didn't get back to its 1929 peak until November 1954.
25 years, a quarter of a century. That really shows the depth of the impact.
It absolutely does.
Yeah.
The crash wasn't just a stock market event. It bled into everything. It's seen as the start of the Great Depression.
The biggest financial crisis of the century.
Without a doubt. The psychological impact alone was huge. Uncertainty everywhere. People worried about jobs, stopped spending money.
And businesses felt that, right?
Oh, yeah. Bankruptcy soared. Businesses closed down. Mass layoffs. And then the banks started failing.
Which made everything worse.
Much worse. Bank failures meant people lost savings, the money supply shrank, credit dried up, the economy just seized up.
Now, you hear debate, don't you? Did the crash cause the depression or just sort of coincide with an already weak economy collapsing?
It's a major point of discussion for historians. The fact that only, 16% of households own stock suggests the crash wasn't the only factor.
Right. It couldn't have directly ruined everyone.
But it triggered a massive loss of confidence, it exposed the weaknesses, and accelerated the downturn dramatically. It was certainly a catalyst, even if not the sole cause.
And the impact went global.
Absolutely. There was a run on U.S. gold reserves from overseas. The Fed actually had to raise interest rates, which hurt the struggling U.S. economy even more.
Counterintuitive. And thousands of U.S. banks failed.
Around 4,000 banks and lenders went under in the following years, just gone.
Any immediate rule changes?
They brought in the uptick rule for short selling, trying to stop sellers from driving prices down relentlessly.
And Europe felt this too.
Directly, very directly. Global economies were linked. It triggered bank failures and economic hardship across Europe, unemployment, protests. The UK had major issues with its means test for aid.
So, academically, people started digging into why this happened.
Yes. The Pecora Commission was set up in 32 to investigate.
And that led to reforms.
Big ones. The Glass-Steagall Act in 1933 is the most famous. It separated commercial banking, taking deposits, from investment banking, underwriting stocks.
Trying to curb that risky speculation by banks.
That was the idea. Create a firewall. Stock exchanges also brought in circuit breakers rules to pause trading during huge drops.
Have we seen similar drops since, percentage-wise?
We've had big crashes like Black Monday in 1987 and the COVID crash in 2020. But if you look at that two-day drop on October 29,
Black Monday and Tuesday combined.
yeah, that 23% drop was actually larger in percentage terms than even the 1987 crash day. It was incredibly severe.
And some economists like Friedman and Schwartz argue it wasn't just the crash.
Right. They argue the real disaster, what made the Depression so deep and long, was the collapse of the banking system between 1930 and 1933. The Fed's failure to act as a lender of last resort, they said.
So the crash was the spark, but the banking collapse was the fuel for the huge fire.
That's one influential perspective. And it's interesting, the economist noted years later that right after the 29 crash, it wasn't immediately obvious a decade-long depression was starting.
Hindsight is 20/20.
Exactly. The full scale only became clear over time.
Let's circle back to those underlying economic factors mentioned in the document. Before the crash, agriculture again.
Yes, the wheat problem. Good harvests led to oversupply. Prices tanked early in 29. There was a brief recovery due to a drought.
But then more supply came online from Europe and Australia.
Right, so wheat prices fell again. Farmers were really squeezed. It shows not everything was booming before the crash.
And other indicators were slowing by mid-1929.
Definitely. Car sales, house sales, steel production, key parts of the economy were already weakening.
So the foundation was shaky before the market peak.
You could certainly argue that. Albert Wiggin, head of Chase Bank, called the crash the natural fruit of the orgy of speculation. A pretty blunt assessment.
And Kindleberger's point about the lack of a lender of last resort.
Crucial. No institution stepped in effectively to provide liquidity when the panic started, allowing it to spiral.
Some also blamed abuses by utility companies and banks playing fast and loose.
Yes, those were common criticisms. Believes that risky investments by commercial banks and complex structures in utilities added to the instability.
And the wave of bank and business failures afterwards seems to bear that out.
It paints a grim picture of the economic destruction that followed.
Okay, so let's try to pull this all together, this deep dive. It shows a confluence, doesn't it? Post-war hope, easy money fueling speculation.
Dangerous levels of borrowing through margin buying, underlying cracks in the economy being ignored.
And then specific triggers in late 29 lighting the fuse.
Exactly. It wasn't one single thing, but this potent, interconnected mix. The crash exposed all those vulnerabilities.
And the key takeaway really seems to be that interconnectedness, how things can spiral with unforeseen consequences impacting the whole world.
Absolutely. It led to the Great Depression, a decade of hardship that reshaped societies globally.
Which leads us to a final thought, maybe a bit unsettling. When you look back at 1929, how do those lessons apply today? We still talk about regulation, speculation, market bubbles. Do you see echoes of the Roaring Twenties in our current financial world? Are the safeguards we have now truly enough to prevent something like that happening again?
That's the multi-trillion-dollar question, isn't it? What have we really learned, and are we protected from history repeating itself? Something for all of us, especially you listening, to think about as we watch today's markets.